Well, I think there are two things. I think, first of all, it is the Fed, but also it's the state of U.S. companies and their ability to generate cash. I mean, everything that your previous commentator, Lindsay, said, I completely agree with. But I think one of the other things that we're focusing on credit markets is just how strong the earnings have been and how strong the operating cash flow for U.S. companies have been recently. And so there's a combination on the one hand that the credit fundamentals of companies actually look very good. But on the other hand, we're dealing with a world with a lot of supply. So particularly given the fiscal changes that we've had in the U.S., everybody expects to see a lot more Treasury issuance. And there's a little bit of a concern about whether that could, in the medium term, crowd out demand for corporate bonds from the investor base, too.
Is it fair to say, Guy, that the health of the credit markets here in the U.S. are still intact? Is it fair to say that things are actually okay on that side of things? We haven't been seeing a lot of stress, at least not yet, on that credit side of things, whether it be investment grade or on the high yield side.
Well, that's absolutely true. I mean, I think the surprise is that globally, U.S. high yield had a tremendous performance if you compare it with things like European high yield or certainly emerging market corporate bonds since the beginning of this year. U.S. high yield did even better in terms of spread movements than U.S. investment grade. U.S. investment grade spreads have gone wider, but I think that's had more to do with supply and with technical factors than it has to do with actual credit quality. So I think there's a good case for saying we should expect now a bit of stability in terms of the U.S. credit market, even if other credit markets globally could continue to come under some pressure.